G'day everyone, welcome back to Pete's Investing. Today's strategy video is my Christmas gift to you to hopefully inspire you to adopt some of the rules and disciplines to steer you onto a successful and profitable trading career. Yep, I said career. Do this right, and after some initial grounding, then you can develop a passive income to even overtake that job you might be doing now working for someone else. Okay, first of all, anyone can make money in a bull market. In good times, just buy almost any decent stock, hold it and sell it when you are satisfied with the returns made. What do I mean by that? Well, when we're in a bull market, there's very little in terms of strategy at play. If you are lucky and pick the right type of stock, then sit back and let the market dictate your terms. Note the two words, luck and dictate. Almost all new traders can put down to luck when they make a few good returns. And likewise, almost all new traders are dictated to by the markets where the trades go in their favour or against them. But to optimise your entry signals, that is when to buy, and closing strategy, that is when to close out the trade profitably, then you need to adopt a trading strategy that suits your trading profile and risk appetite. Don't catch a falling knife. Don't just buy any dips. Use the average down technique effectively. This is where experience shines through. The chances are, if you're new to trading and you don't follow a disciplined trading strategy, then you will get kicked in the guts. And yes, that hurts. To minimise that pain, then I want to help guide you through the following. So, when the market turns against you and you're caught in a trade, then you need to know how to average down your holdings and ultimately close out the trade profitably. We don't use stop losses. We don't just buy blindly, that is, we don't try to catch a falling knife, as the saying goes. So what do we do? Okay, so we need to be cash flow positive, and you must be capable of covering all day-to-day expenses beyond your trading, and don't borrow it to invest unless you have a good cash reserves and good cash flow. This is where good money management comes into play. Money management is pretty much the secret to successful trading. Couple good money management with a solid trading strategy, then you're on your way to success. Now, if you're a newbie trader and watch this video so far, then I strongly suggest you watch till the end and take notes. And yes, very importantly, reference those notes as often as you need to and program yourself with these disciplines. Or rewatch this video and some of my strategy videos listed in the description below as often as necessary. The money management video is one of those descriptions below, as well as some trading strategy videos. You don't become good at anything by doing it once. Repetition is the key. I frequently analyse new trading strategies and compare and rank them in this table showing revenue potential and drawdown effects. Over many years, I've backtested many strategies to capture the effects of significant downturns in the market to see how that affects your holdings. Backtesting includes down periods such as the GFC, COVID, and more recently the Ukraine-Russian conflict and recessionary events. Reference any of my strategy videos on my channel to paper trade and test their effectiveness. I've also added some of the best performing strategy videos in the description below. So let's get started with this video. Okay, first off, I want to show you my overall trading strategy in terms of when to get in and out of trades and when to average down. Before you do that, let's assume we've chosen a trading strategy from one of the many listed in the previous slides. And it doesn't really matter which strategy you choose, they're all profitable. But let's assuming you're choosing a moving average entry strategy on a finite timeline. So in this case, let's assuming we're trading on a daily. That's the daily chart here, and this is a 4-hour chart. So again, you have to pick on what time frame you need to trade. So if you're trading indices, CFDs, ETFs, you may want to trade on a lower time frame like the hourly or even the 4-hourly. My weekly update videos cover daily, 4-hourly, and hourly time frames, and they're just guidelines in terms of when to get in and out of trades generally. And I say generally, and that depends on your risk appetite. So for instance, let's look at here the S&P 500, and I'm using here my overall arching indicator to get in and out of trades. Now, why don't I use the moving average as my master indicator to get in and out of trades? So, for example, you could use the moving average 200 on a price chart. So, when the price breaks above the moving average 200, which a lot of traders use as a guide, you could go long. That is, that's when you buy, and you could say, right, I want to sell this particular instrument when the price breaks below the moving average. Now that works on moving averages so long as you have this sort of increase in price. So if the price chart is very volatile and starts low and finishes high, then that's a pretty good strategy to follow with moving averages. Now notice something here. I'm using the CSI 1500 as my key indicator to get in and start trading at the lower time frames and stop trading when the price or when the CCI breaks through its moving average. So here we've got the CCI 1500, the jagged black line with its moving average of 400 applied to it. So you'll notice here the CCI breaks below its moving average at that point there. You'll notice up there the price continued to rise a couple of months after that. Now you might say, well, Pete, you're missing out on a bit of profitability in that little period there. But notice the CCI started dropping, so there's a bit of divergence in the CCI versus the price chart. Divergence is when the indicator goes in the opposite direction of the price. So that gives you an early indication of exiting this particular trade if you're trading this daily. Now, to trade at the lower time frame, using that same example, let's drill down to the start of 2020, straight after COVID happened. So assuming you weren't in any trades, any long trades during the COVID drawdown there. So on the 4-hour chart, for example, if you're trading the 4-hour period, you would start trading at that point there, where the CCI broke into an upswing, and you would have stopped trading when it went into a downswing there, when the CCI broke below its moving average. Notice on the daily chart where that indicator is shown. So on the daily, if you're trading the lower time frame on this side, you would have got out of the trade about there. So again, when you're trading the lower time frame using one of the strategies, you would enter there and exit there. Now notice what the CCI is doing here versus the price chart. The CCI is running flat and the price chart is increasing. You might say, well, how do you trade that? Well, again, we look at the bigger time frame. So if we're trading the 4-hour period, in the bigger time frame, the CCI is still in an upswing. So we're taking long trades only. So at that point, you would buy there because the CCI on the 4-hour chart is in an upswing. So you would buy there at that point on the price chart. You would exit somewhere probably there when the CCI breaks below its moving average. So notice the price dropped there. So you would exit the trade there. Enter the trade again when it's turned green. Enter the trade again there. Exit the trade there. You probably would have entered it there and exited just a few days afterwards. Enter again there and exit again there. Notice on the left where I am with the cursor, the CCI is still in an upswing. We're ignoring this moving average. We're saying if the CCI is above its moving average, we're taking long trades only. We keep going. We enter the trade there, get out of the trade there. Enter the trade there, get out of the trade there. Now notice where we are on, going back here, sorry. Notice where we are there. You would have got out of the trade there. Now, the price was on a 4-hour chart was in a downswing and it started turning up there. But notice on the left, the CCI is still below its moving average. Even though the moving average has turned green, if the CCI is below its moving average, we don't take any long trades. We may want to start taking short trades from here on because the CCI is below its moving average. Now you might say, well, that's counterintuitive because the price is still going up. But notice what happened afterwards. From there on, the CCI kept dropping, and we're still in a downtrend today. So if you've been in short trades ever since, you would have been profitable during this period, and you would have been profitable since back here, since September 21. If you had taken only short trades in the lower time frames, you'd be profitable. That's how you trade. So in other words, for trade the smaller time frames, using the higher time frame, in this case the CCI 1500. The difference between the CCI moving average and the moving average 200 in the price chart is this one gives you a bit of a heads up in terms of change, whereas this one is very much a lagging indicator. This one is almost, I wouldn't say predictive, but almost predictive as an indicator. This is the S&P 500, so that's just eyeballing it. You can see there, you would have got in the trade there overall, long trades, and got out of the long trades at this point, when the CCI turned to the downside below the moving average. Let's look at another index. Let's look at the ASX 200. Same sort of thing. You would have taken long trades from there on and stopped taking long trades at that point. And that gave you a bit of time, a bit of a lead time to get out of trades profitably without losing money, without being caught in trades. You may have got into long trades again there, but got out of it again at that point there. Let's look at another couple of indices or indicators. Let's look at spot gold. Okay, spot gold, you can see here, take long trades from that period, ignore the moving average, take long trades from that period, there, all the way up. This is again looking at the 4-hour chart only. Take all those long trades, you probably would have got out of the long trades at that point, started taking long trades again, and then stopped taking long trades at that point. And again, you're given a few weeks or even months to get out of any long positions profitably. Let's look at silver. Okay, take long trades here from there on, and stop taking long trades there and start taking short trades from there on. Now you may have been in the red had you taken short trades there because it went up, but notice how the price has depreciated and come down. It's only just started going long again. If you look at the silver price chart, and I'll cover this on the weekly updates as well, the moving average is broken to the upside. So start taking long trades on silver as of a few since the start of December. Let's look at the US dollar. Again, taking short trades from there down and start taking long trades from there on. Stop taking long trades there. And we're in a decline and we're in a short trade environment today. Lastly, let's look at the NASDAQ. As another example. Very similar sort of patterns. Take long trades from there. Probably would have stopped taking long trades at that point, even though the price is going up. So you probably would have gotten out with some profitable trades. Probably stop trading long there, and then stop trading long there again. But notice also the price kept going up, so it gives you a bit of time if you're caught in long positions to close out profitably. Probably would have caught in a long trade there, stop. So you would have been caught in and out. Again, we're trading the 4-hour chart in this case, don't forget, or the hourly chart. So again, here we caught in a downtrend. All right, take short trades only. Don't take long trades there because the moving average is still in a downtrend. Start taking long trades there because the moving average is an uptrend now. Take long trades. Stop taking long trades. Maybe start taking short trades and so on. Long trades. Stop taking long trades. Start taking short trades. So that's it. Follow the trading strategies and money management videos at the end of this video. Some trading rules that are added. Pick a trading strategy that suits your style and risk appetite, and you'll be on a good path to successful trading. During the weekly market updates, I mention the strategies that I use and make recommendations on to track the potential direction of the trends when applying your strategy. Well, to pick a strategy you can work with, go to my homepage, click on the playlists, then click on the strategy playlist, and then browse through and choose a strategy that works for you. And that way you can trade profitably and do it without too much risk, as long as you follow the strategy itself and the market direction. Here are some of my investing rules: buy proven blue chip stocks, buy stocks which pay dividends, don't short positions, go long only. And the reason for that is you want to receive those dividends when they're paid, and don't trade on news. Price is already factored in the share price. Thanks for watching. Don't forget to click the subscribe and the like button and click the notification bell to get all. Merry Christmas to all traders, and especially my loyal subscribers to my channel. Have a hot summer Christmas.